Well, good afternoon, everybody, and thank you for taking time today to join us. It is an absolutely beautiful day here in Dallas, Texas, and I appreciate you taking 30 minutes of your time to learn about the markets, what we're thinking about the markets, what on earth happened in 2016, and what we think is going to happen in 2017. We have a lot to talk about today, so without further ado, we will go ahead and get started. A little bit of fun hometown news for today. I saw right before I came in to talk to you all that Rex Tillerson was just named Secretary of State. Who knew that that was going to get through? I think that's pretty exciting news for all of us in Texas and hopefully throughout the United States. So Trump is obviously moving quickly. His confirmations are moving quickly, and you'll hear lots of discussion about that today as we walk through how all those things are going to affect the market. There are a number of different themes that you will hear. You will hear Trump as a theme over and over again. His election has absolutely changed the tone that is in nearly all of the financial markets, not just in the U.S., but certainly abroad. We are in what is called a risk-on sentiment now. There's been a risk-off sentiment in the markets, especially in the stock market. And what that means is that people are not really willing to take the risk of investing because they weren't sure that the reward was going to be there. So there's been a strong risk-off tone, especially over the last few years. If you all remember, in 2015, the market really didn't give us very much in the way of returns at all. And it makes investors think, well, why am I even invested if we're not really going to get the returns? Why am I taking the risk of investing? With the very strong change in sentiment that we see under Trump and what he is considering doing with his various policies, we see very much a trend towards the risk-on investment scenario. I read an article this week that talked about animal spirits being awakened, and I thought that was such a great way to phrase it. So we see that not only in the financial markets, but certainly amongst business owners, small and large. So we'll see risk on as more of a trend. We'll also see the idea of diversification. That has been a theme as long as Brennan Financial Services has been in office. But what we will be seeing is what happens with diversification with people who may have gotten scared last year when the market started off in such a bad way. And then what we saw at the end of last year was a really good reminder to investors of all sizes to stay invested over time, because that really has been what has been successful. We'll also be talking a lot about the change in sentiment at the Fed. A lot of that change in sentiment has been a response to the Trump policies that we believe are going to be put into place. And there are two different kinds of policies to think about as we go through the information today. There are two different ways to stimulate an economy. So we have been under the monetary policy of trying to stimulate the economy. So after the 2008 downturn, the Fed came in and said, we're going to do everything that we can. They had all sorts of quantitative easing programs that we've talked about for years and years and years. And the last piece of the puzzle that they had was to keep the interest rates low. And as soon as they started raising the interest rates at the end of 2015, that was the end of them saying, okay, we're going to be as accommodative as possible. They have now been inching up the interest rates. We saw them raise interest rates once at the end of 2016 and are now in a completely different tone and saying that they are going to raise more dramatically, and I'll go over that in more detail later on in the session. But that is the monetary policy that we have had that was supposed to stimulate our economy. And what we know has happened over that 8-year period is that it didn't do much for us. And so we've had a very slow growth environment, and we never got back into the full swing of an actual economic rebound or recovery, which we would normally see coming out of a recession as bad as 2008 was. We are now shifting into a completely different kind of policy, and that is fiscal policy. Fiscal policy is where the government uses spending and tax rates to influence the economy. That is very clearly what Trump is doing. And at the same time, the Fed is now saying we are absolutely coming out of the business of having accommodative monetary policy. So this is very much a shift in the way, not only for the markets to consider, but in the way that the actual economy is going to be stimulated. So I want you all to be clear on that and to think about that as we go through some of the numbers. So we'll be talking about the Fed sentiment change, what that means for everybody and what it meant at the end of last year. And then the other thing is the way that business is looking at Trump and the way that the money managers are looking at Trump. Business is very excited. So small business, large business is very excited. There are lots of great things that Trump is talking about, including deregulation, lowering corporate tax rates. So those things are very exciting. What is not as exciting to money managers is some of the other things that are coming up including taxes that will be imposed in the way of changing trades and tariffs and those sorts of things. So I'm going to be very clear about that also, what money managers are thinking versus what the business community is thinking. I think every business person that I know has been kicking up their heels since November, and money managers are much more guarded about what they are considering going forward in 2017. We are excited about the possibilities of what we see ahead of us, but we also know that the proof is in the pudding and that there's a lot that needs to be done before we can actually move forward and get all these policies working together in the same direction. So we'll be going over all of these issues as we go through the market review. We'll be talking through all the different countries and the different parts of the market, and we'll be talking about diversification in the end, as we always do. So let's look at the market summary for any of you who are new to the phone call for the first time. These are index returns. These are not the returns of any of our portfolios, and everything that we talk about on this phone call will be based on indices and not on the performance of any one portfolio that we manage. This is all fourth quarter. So when you look at this, you might think, well, gosh, we would have expected these to be all arrows pointing up. This is fourth quarter 2016. So you see the U.S. stock market was up 4.21%, and I'll give you a little more color commentary about that as we get further on into the slides here. Importantly, international developed stocks down, emerging market stocks down a lot, global real estate down 5.11%, U.S. bond market down nearly 3%, global bond market down 2.21%. So what we heard from some clients was, gosh, the Dow is hitting all-time highs. Why is my portfolio not hitting all-time highs? When we saw the change in sentiment after the election, it caused the stock market, obviously, to have great returns, and it also caused other parts of the market which are dependent on interest rates to go down, mainly because the Fed had such a change in the way that they delivered their statement in December. So what happened in December with the Fed is that they came out and had a quarter-point increase in interest rates. So the target is now 0.5 to 0.75%. But what they said was, because of the Trump policies, they believe that inflation is on the horizon, and therefore they believe that they will have to raise rates 2 to 3 times in 2017. Having said that, they said almost the same thing at the end of 2015 about what they were going to do in 2016, which means that they said at the end of 2015, oh my goodness, we're going to raise rates 2 to 3 times in 2016. Everybody get ready for it. And they only raised 1 time at the end of December. What was different is that they have a different president who has polar opposite policies to the previous president, and so we finally have reason to believe that the Fed may actually raise rates 2 to 3 times. And raising rates 2 to 3 times would only get us back to an interest rate that is still very low by historical standards. If they raise 3 times at the end of 2017, we would have a Fed interest rate of 1.375%. Historically, that is still extraordinarily low. However, that would be a bigger move than we've seen in more than 10 years as far as interest rates increasing. So anything that is interest rate sensitive, specifically bonds, real estate, and emerging market stocks, all of those had a sharp negative return at the end of 2016. And so anybody who was well diversified and was exposed to those areas of the market also saw a decrease in those assets while we saw a sharp increase in the stocks and the equities on the U.S. side. International developed was slightly negative, but we could just even say that that was a flat return, so there wasn't a whole lot of change there, and again, we'll look at a little more detail on that as we move on. Looking at the world stock market performance now, all of this is headlines that we saw in the last quarter. I'm not going to drill down into these because I think the next slide where we look at a year's worth of headlines is much more interesting. The one thing that I do want you all to look at here is the bottom where it says, these headlines are not offered to explain market returns. Instead, they serve as a reminder that investors should view daily events from a long-term perspective and avoid making investment decisions based solely on the news. The news is in the business of creating more news, and negative news sells, as we know. And so it is important for investors to really look at the long term, especially as we get to the end of these slides and you start to look at the long-term numbers of what the stock market has done. Last year started out pretty scary, as we'll see. In fact, it started out with the worst year ever. It was the worst start to any year that we have ever seen right here in the beginning. It wasn't comfortable in our office. I will be very clear about that. It did feel like it was very tenuous at the beginning of last year, not tenuous enough for us to come out of the market, but certainly it was a scary time. China had devalued their currency at the beginning of the previous, or the end of the previous year, and oil prices had dropped to levels that nobody really expected, and then the stock market followed suit. And so it was a very skittish start to the year, and people were wondering, is this actually the repeat of 2008? Is this the other shoe falling that we've been waiting for? And in the end, what we saw was that the market then turned positive for the year once we got to about March. So it was a fairly actually short-lived downturn. And what had happened is that the market had not had a downturn in a long time, and people weren't used to it, and it felt pretty uncomfortable. And so we saw that nice, clean sweep. We needed that. We've been waiting for that as money managers for a number of years for that to happen. So it was actually good and healthy for the market. It just feels terrible to everybody every time you go through it. But what then we saw was this huge rebound at the end of the year. In the meantime, we saw some conflicting pieces of news. So we saw here that the U.S. jobless claims fall to the 4-decade low. That happened in the spring of last year. Interestingly, the response to that from the Fed was that weak hiring pushes back the Fed's plans. So again, this goes back to what the Fed is putting out there in the way of media releases versus the Fed's actual action. We saw U.S. jobless claims fall to a 4-decade low, and a month later, the Fed says, well, because of weak hiring, we're not going to increase our interest rates. There was a big call back then that maybe the Fed is avoiding raising interest rates, and in fact, that seemed like that was pretty much what was going on. The Fed has 2 mandates. First mandate is to maximize employment, and we're there. We were there as far as the spring of last year. The other piece of it is to keep inflation in check. And we have not had inflation for many, many years. We've been well under the Fed's target of 2%. So that really is what's been going on. The Fed has not been motivated to increase the interest rates. Certainly it was not because of employment, but that was what they talked about back in May. And whenever they talk about those kinds of things and they say weak hiring, then people think, oh my goodness, what's happening then with the economy? And then the stock market drops off, and that's where you see the kind of dips that we see down in this part right down here. So then we went through a whole bunch of election stuff. We actually had Brexit that happened on June 23rd. So Brexit happened right around in here. Actually, probably if I was drawing this correctly, Brexit happened right here before the dip in the market. The dip was very short-lived. So we saw that Brexit happened. We actually thought that it would be a great buying opportunity and anticipated being able to have about 2 months to be able to put money in the market. It was very short-lived and popped right back up. One of the other things that we've been seeing is that anything that happens in the market that seems scary, that seems headline, the market's getting more used to it and is shrugging it off much more quickly. So after Brexit, there wasn't a whole lot of news. A lot of people were waiting to see what was going to happen around the election, and we saw some positive headlines throughout here. Interestingly, we saw world trade set for the slowest yearly growth since the global financial crisis. This is important for us to look at, as well as the fact that the global inflation falls to the 7-year low. What has been happening for a long period of time is that the entire global economy has just been slowing down. And I keep saying it's like there's a wet blanket over the entire world. So we set our interest rates at 0. Other central banks thought, well, that's a pretty good idea. Americans are pretty smart. If they can do it, we should do it. They brought their interest rates down very low, and I've talked about this many, many times now. Some countries even went negative. The most insane thing I've ever heard of, but we had negative interest rates for about 1.5 years in more than 10 countries, including Japan and Switzerland, and big, stable countries where you would not expect that they would go to extremes like that. It seems now that the trend for negative interest rates is over. It was a short-lived, thank goodness, a short-lived experiment. And the countries that did it realize that there's no positive net effect from that. But what does happen is interest rates are an indication of future growth. And so if we have negative interest rates, what we're saying is we are not anticipating growth in the near future. And that's where we get these issues of world trade set for the slowest yearly growth since the global financial crisis and the global inflation falling to 7-year low. The central banks around the world were basically telling their citizens and their economies, we don't expect growth. We don't know where it's coming from. That's why we're going negative. We are now seeing those countries return to even interest rates, they will probably eke back up more positively. And now that we have seen that our central bank is setting precedent and saying we anticipate that we will increase 2 to 3 times this year, it gives more motivation for the other central banks around the world to also get to more of a positive interest rate cycle. That will be very good for growth. I have said so many times, not only about financial markets, but just in general, that the whole globe looks to America as dad. And so whatever dad does, people are going to look and see what's going on. And of course, I don't mean my dad. I mean the classic dad. So America sets the tone for what is going on around the world. We have for decades and decades. We will likely do that for decades and decades. And so what our central bank does, it really does affect the entire world. And that's where these changes that Trump is proposing could be extremely good, not only for the U.S. economy, but for the global economy. So if some of the things that he's talking about puts us back into the risk-on, the pro-growth kind of environment, we could see a ripple effect of that around the entire world. So we have been in this paltry return cycle, not just here, but everywhere. So then we see, ta-da, Trump wins. We know that story, so I don't need to go into that. But then we see here, immediately after Fed lifts rates, signals more increases next year. So Trump winning is a big deal, and the Fed changing their tone is a big deal as well. Those are the two major sentiment shifts that have completely changed what we believe we will see going forward, not just this year, but in the coming years. And I will say that I am much more positive this year than I have been probably for 3 or 4 years about the possibilities of growth, what could possibly come ahead of us, and what our economy could potentially do. So let's go ahead and drill down into some of the asset classes here, because this is an interesting story to look at. Again, these are fourth quarter returns. These are not full 2016 returns, but fourth quarter. And this tells quite an interesting story. So the market basically instantly baked in the Trump agenda. And this is part of the reason that money managers are concerned about 2017 returns, because the minute that he was elected, well, actually what happened was overnight, where it looked like he was about to be elected, the market went down, the futures market went down about 800 points. As soon as he made his acceptance speech, it came back up, and then we have been on an uphill climb ever since then. So the U.S. financial market instantly baked in everything that he had campaigned on as if it was already done. We all know that it's going to take a while to get all of these things actually worked in, working together, and moving in the same direction and helping each other. And so that's where the money managers have a bit of a disconnect with business owners, where business owners are saying, oh my gosh, with deregulation and lower taxes and so on, so many things that I could do to grow my business. They have an instant feeling of euphoria about that, whereas money managers are saying it's going to take a little while for all of these pieces to come together. Mohammed Al-Arian is a money manager that I follow, and he writes a lot, and he's very widely respected in our industry and has managed some very impressive sets of assets. And he had an article this morning in Bloomberg, and he put it very succinctly. He said, we're getting to a tipping point where we're either going into beneficial reflation or damaging stagflation. He goes on to say, specifically, the implementation of a well-designed set of policies built around the president's 3 headline initiatives, tax reform, deregulation, and infrastructure, would unleash reflationary forces that would validate existing asset valuation and could take them a lot higher if the rest of the world were also to improve its policy mix. If, however, the U.S. stumbled into protectionism and trade wars, the markets would give up more of the recent gains and possibly even overshoot on the way down. Where markets go from here is therefore a matter of politics more than anything else, with both U.S. and international dimensions. That is a strong statement to talk about, that really we are depending on politics and the way that the policies will be implemented about whether we can get into growth or whether we're going to stumble and see that the stock market would fall back some and potentially the economy would either stagnate, which is that stagflation, or would retrace a little bit. My dad has an old joke that he used to use on the radio, which is that if inflation is bad and deflation is bad, is inflation okay? And I think that what we have realized is that almost anything having to do with inflation is probably a negative. Reflation, in case you haven't heard that word, just means that we are going from either a deflationary or a stagflationary environment into a growth environment where we would see inflation. So a lot of people that talk about Trump are talking about his reflationary policies that he is trying to put into place. And certainly that is what growth is all about. Inflation simply means that the prices are going up on goods and services. And a growing economy is going to generate an environment where prices are going up on goods and services. So we, again, have had this wet blanket over the entire world, and we need to get back into an environment where we are generating growth. So having said all of that, let's go back to the slide and look at what happened. The Russell 2000 Value Index, you can see that it had a return of 14.0% in one quarter. We haven't seen returns like that on the Russell 2000 in quite some time. The Russell 2000 is a small cap index. So normally what you're used to hearing about is either the Dow or the S&P 500. The S&P 500 is the top 500 largest U.S. companies. And so then when we add in 1,000 or we go to 2,000 or we go to 3,000, what we're doing is adding in more and more companies, including the mid caps and the small caps. So a Russell 3000 is going to have the greatest number of small caps in it. S&P 500 is almost purely a large cap index. So we can see that we had this 14.0% return on the Russell 2000 Value Index. The other thing that we've seen is there's been quite a difference between growth and value. And value seems to have come back more into play now that we've had this change in sentiment, which is somewhat interesting because we are going into a growth environment. But value seems to be an area of focus for us going forward. Moving on to U.S. stocks, so this, again, fourth quarter 2016 returns, and so it's interesting. We'll look at the fourth quarter returns and then drill down into what that looks like longer term. So this is the same number that we just looked at here, 14.07 on the small cap value. Interestingly, large cap growth only did 1.01%. So you might think, well, but we heard that the Dow Jones was setting all-time highs. The Dow Jones is only 30 stocks, and the majority of the returns that we saw in the fourth quarter on the Dow Jones Index was all about financials. Banks will undoubtedly benefit from deregulation, and so the amount of deregulation that Trump is talking about should be very beneficial for banks, and that's why those stocks had such a massive acceleration at the end of 2016. There's some question about whether there's still room for those to grow in 2017. I would imagine that there's room for growth simply because as more and more deregulation happens, they should be able to go into more of a growth mode across the financial sector. So this is the fourth quarter returns that we're looking at. Now if we look down at the 1, 3, and 5-year returns, so if we look at small cap value from a 1-year return down here, 31.74%. That is absolutely huge. And so again, there's been a major sentiment change there. Interestingly, if we look across the 3-year numbers and look straight down there, we're looking at pretty solid returns. If we look across the 5-year numbers, we've got 14s and 15s and 13s throughout the entire column. And looking at those numbers, those are also very solid returns. The one number I really want you to look at is the 10-year number. So it is February 1st, 2017. If we go back 10 years, it would have been February 1st, 2007, which means that it was before the 2008 crisis. And so even with the 2008 crisis built into these numbers, we still see returns of 5, 6, 7, 8% for someone who stayed invested for all of those 10 years. And while none of us would ever welcome 2008 back in our lives, it is very interesting to see that those returns are very close to what the average returns are, even built in with the 40% downturn that we saw in 2008. Moving on to international developed stocks, the story is quite different, which is very interesting. So again, we saw value do very well last quarter, so it's 12.27% return on the international developed stocks. Unfortunately, we don't see the same kinds of returns if we look out to a 10-year number. So the 10-year column on the international developed stocks is very low. It's almost flat. If we look at the 1-year numbers, they're really not significantly better. The 5-year numbers are where we see some good returns on international stocks. And you might say, well, what is behind that? How does that make any sense? We have seen, like I said earlier, we saw the negative interest rate policy, the very low interest rate policy on the developed international economies. So we're thinking of Europe, we're thinking of Japan, we're certainly thinking of Canada. And so they did not have the kinds of returns that the U.S. did over the same time period. Not only that, but especially over in Europe, they have had quite a bout of immigration to have to deal with, and they have had huge population problems, and so they have not had the opportunity for growth. A well-balanced portfolio is going to include international stocks and bonds. However, because of these long-term numbers, and actually just because of what we're seeing right now and what we believe we're going to continue to see going forward, at the end of last year, we did reduce our allocation to international stocks. We didn't eliminate it, but we did reduce it, and we will have that underweight. We'll continue that underweight through 2017. There is some good news coming out of Europe. It does look like it is just about to turn potentially, but we don't see enough good news to feel like that's a place for us to go to try to get better returns than what we would anticipate seeing in the U.S. So we will remain overweight in the U.S. going forward. Moving on to emerging stocks, this is a very interesting chart to look at. So when we talked about emerging stocks in one of these webinars last year, we just saw really nothing but what we see here in this 3-year period return, which is all negative. And it had been either negative or flat for 3, 5, and 10 years. We still see those numbers that are pretty bad. So even if we look into the 5-year numbers and the 10-year numbers, we would not say that those were positive contributions to a portfolio. The 1-year numbers, however, are strong. So the large cap numbers and the value numbers are strong. Growth is good. Small cap is not quite as good. What happens with emerging stocks is that sometimes when the Fed increases interest rates, the opinion in the world is that then consumers in America may not have as much money to buy goods and services, in which case we would not be buying as many goods that are developed or shipped out of the emerging markets, in which case the emerging market economies may not be as strong. So it sounds like a long way to go around the barn just to be able to get to what's causing some changes in the emerging markets. But last year, at the beginning of the year when the Fed was not raising interest rates very much, the emerging markets had a pretty good heyday. And if you remember at the beginning of the webinar, we talked about the fact that emerging markets had actually lost value. And so we saw that right at the end of the year. These 1-year numbers are even after that fourth quarter loss. So we are watching the emerging markets closely. Where we have them, we are holding on to them. We are not increasing our allocation to emerging markets right now, and we are only using them for clients who have a high risk tolerance. But we are staying with them right now, and we'll be watching them in response to the Fed interest rates and whether they increase or not. So looking at country by country, I'm not going to spend a whole lot of time on this. I find it interesting that in developing markets, Italy beat us last year by a pretty substantial margin. They have some interesting things going on politically that I'll be writing about later on this year. And in emerging markets, Russia had a pretty good year, as well as Greece. And if you all remember, a few years ago, Greece seemed to pop up every few months and cause our stock market to drop. And so Greece having a great year is probably good for everybody around the globe. Also, the select currency performance versus the U.S. dollar. The U.S. dollar is extremely strong. So if you look either against developed markets or against emerging markets, almost all of them were negative against the dollar. So all of these numbers are specifically how did they trade against the dollar. And they were almost all negative, mainly because the dollar is so strong. And so the dollar we anticipate will continue to be strong. That is good. It's a good indication that we have a strong economy and potentially a growing economy. A strong dollar can be bad for our exports because they are more expensive to the other countries. And so it is something that this new administration will need to be focused on to make sure that as we continue to have a strengthening economy, that it doesn't wind up hurting our export business, which we have a great deal of. On REITs, real estate investment trusts, I did talk about this quite a bit last year and how we have incorporated real estate into a good number of our portfolios, and we believe that there's a very substantial place for it going forward. Again, if we go back to the numbers, if we go back to 10-year numbers, which includes the worst downturn that real estate has experienced in our history, that still has a 4.63% return factoring in the 2008 downturn. If we take the 2008 downturn out of it and we look at the 5-year numbers, the 3-year numbers, and even the 1-year number here, those are all very solid returns. The one-year number, if you remember, again, at the beginning of the webinar, we had a downturn on the real estate investment trust at the end of last year when the Fed came out and said they would be raising rates 2 to 3 more times in 2017. The reason for that is that part of the success of REITs lately has been that money has been so cheap. It's been very inexpensive. So it's been very easy for people who wanted to buy real estate to go out and get a loan at a very low interest rate. And so that has really been a huge benefit to the real estate market, commercial and private and residential, multi-tenant, every kind of real estate that's out there. It's been a very easy lending environment, and so it's been easy for real estate deals to get done. And so once the Fed made their change in sentiment last year, then we saw the real estate drop off a bit. We anticipate that we will come back to more normalized returns. So we anticipate that the one-year return is probably closer to what we'll see going forward, but certainly there's still the potential of what we've seen over the last 3 to 5 years. And commodities, as you all know, we do not tend to invest directly in lean hogs or live cattle, but we do like to look at what the commodity markets are doing. We always see some sort of commodities that are going to be out here making huge returns in one quarter at a time. Interestingly, we saw gold drop in the fourth quarter. Gold actually had a positive year for the full year of 2016, but went down 12% in the fourth quarter, and that is mostly tied to the fact that there's more confidence behind the growth policies that Trump has in place. Gold is a fear and greed asset, so it is not a supply and demand asset. And so when there's fear in the marketplace, we generally see a surge in gold prices. And when people feel pretty good about the economy and the stock market, we generally see gold fall off. So gold did not have a great quarter, and it'll be interesting to watch what it does through 2017. I do want to remind you the reason that we don't invest in commodities is what we've seen on a 3, 5, and 10-year number, that they're all negative by a substantial amount. So not only would they not have contributed to portfolio returns, they really would have pulled down portfolio returns. So we are still steering very clear of commodities at this point in time. Fixed income is really the most interesting story that we have going on right now. And again, going back to what the Fed said, when the Fed raises interest rates, it is going to have the most direct effect on conservative fixed income. And fixed income to you and me really just means bonds. And so when we are looking at what is likely to do well or poorly going forward, we can imagine that an increase in interest rates at the Fed will have a negative effect on U.S. government bonds and also municipal bonds. So municipal bonds have been a darling for a long time. We like to use municipal bonds. Many of them generate tax-free income, so they're very attractive to investors that have high income. They also have a fairly steady return. And so if we look at the 3-year numbers at 4.14%, the 5-year numbers at 3.28%, and the 10-year number at 4.25%, those numbers are fairly close to each other. We like to see that kind of consistency over time. What does happen to municipal bonds, and has happened in the fourth quarter definitely, is that they hit headline risk. And so someone will come out and say something about how municipalities will not be able to pay off all of their debt, and municipal bonds across the board will start to lose value. It'll happen for some period of time, and generally what we've seen is that after 6, 8, or 12 weeks, the municipal bonds have balanced out again, have come back to the value that they were at prior to the headline issue happening. The headline issue that happened in the fourth quarter is, again, with Trump being elected, one of his main goals is to reduce tax rates, not only for corporations, but also for individuals. So there was some concern that possibly there would not be as much demand for municipal bonds. And so people who are in higher tax brackets, their tax bracket would no longer be quite as high. And therefore, the benefit of having tax-free income, if that's what they have in their municipal bonds, would not be as great to them, in which case maybe they would sell those municipal bonds. This sort of thing happens on a regular basis. We did see municipal bonds drop off in value, and so the one-year return, as you can see, is only 0.25%. Through the beginning of the year, they've staged a rebound, and certainly once we know what the Trump tax cycle looks like, we'll be clear on what that looks like going forward. We still really like municipal bonds just for inherently what they are and what they do in a portfolio, so we don't intend to reduce our allocation to municipal bonds at all, and in fact, we've been buying some of those for some of our clients. Long U.S. government bonds, you can see that over the last 3 years, they've had this lovely return of 7.71%. We would anticipate that that's probably coming to an end if the Fed does get more aggressive about raising rates as they talked about in December. So the one-year return here is 1.43%, and we would anticipate a much lower return going forward than we did on the three-year return here of 7.71%. You can see looking back that that's historically high versus what we've seen on the longer-term numbers. The other piece that I wanted to point out is this really high number here on the corporate high yield index, the one-year return of 17.13%. And part of that is that we had a rebound in the oil market. So high yield bonds are going to be the kinds of bonds that are also used by oil and gas companies. And so the high yield bond market was really hit at the beginning of last year when the oil prices went down so much. And so they had a good rebound throughout the year. That's a very high number and higher than we would normally expect going forward. So what we're seeing in bonds and fixed income is that we do need to make a change in the allocation. As you know, we don't make rapid changes in portfolios. We don't do kind of what the market did and just have a knee-jerk reaction. We do watch to see which policies are going to be put in place and what we're going to see going forward. We will be changing some of our bond makeup over the next 3 to 6 months, and you'll see that as we send out your portfolio allocation recommendations. And really the main reason behind it is because of the sentiment changes that we've seen both from Trump and then also from the Fed change. So let's look at the impact of diversification, and this will be our last slide, and then we'll wrap it up for you. So the impact of diversification, this is going to look at what happens over the long term if you're invested in stocks, bonds, or a combination of the two. So with the fourth quarter returns, 100% stock, you can see that the return here was only 1.3%. That's because a 100% stock portfolio is going to include international stocks and not just U.S. stocks. So the fourth quarter return was 1.3%. And going back again to look at what happened over 1 year, 3 year, 5 year, and 10 year, 100% stock return has, or 100% stock makeup has done the best in all of those different scenarios, 1, 3, 5, and 10. However, what we also know is that if we invest people in 100% stocks, they are very likely to want to come out at some point when we see volatility. And that's why we reduce the risk back down to what is appropriate to them so that they can stay invested. If we look at a portfolio that is 50% stock and 50% bonds, the 1 year return is 4.42%. The 3 year return is only 2.03%, and that number is probably the one that is most disappointing to people who do what I do for a living, because over 3 years we would hope to be able to deliver a better return than that, but that really is what we've seen, mainly because 2015 was a flat year across the board in the stock market. The 5 year numbers are much better at 5.07%. And so that's a really good thing for us to be able to see. But the lesson we need to remember from 2016 is that it started off as the worst year that we had had in history and ended up with not only a change in returns and performance, but a completely different outlook for where we would be getting returns and performance going forward. I think that you all know that we love what we do for a living, and we consider our clients to be part of our own family, and we appreciate you being with us. We appreciate you taking the time to join us today, and we appreciate how long our clients stay with us. We really enjoy working with you to achieve the goals that you have through all of this crazy business of politics and money management and economics, which keeps us on our toes at all times. So we really do, we're very grateful that you are part of what we do for a living, and we hope that today has been really useful for you. If you have any follow-up questions, you can email or call me directly or anyone on the team, and we'll be happy to take care of you, and I hope you have a great afternoon.